Hey, what's up, YouTube? Welcome back. This is Scott with Scott Talks Investing. In today's video, I want to stress on the importance of investing early and often and the significance of that for your future self, right? So, in today's society, I think that we kind of sit here and we have so many things that happen so quickly and we have access to things so rapidly and things change so fast with social media and all these things that go on around us. The one thing that we need to keep in mind, though, is investing for our future. I'm not here to sell you something. I'm not here to pitch a product. I really just want to have a conversation and bring awareness to those that maybe are small business owners that don't have a 401k with their employer. Maybe they haven't set up their, traditional IRA or their Roth IRA. Maybe they haven't done some of these things to take care of your future self. So bear with me. I'm going to try to go through this as quick as I can, but I want to just share some of the thoughts that I have for the importance of investing early and often. So we're going to use two different examples. Let's call the first individual Emma, and we're going to have the second individual, we'll just say his name is John. And those two individuals, Emma and John, both want to retire by the time they're 65, and they are both going to start their investing journey at different ages. So Emma's 25 years old in this scenario, and John will be 35 years old in this scenario. So a 10-year difference, and we're going to look at what the impact of that 10-year difference is while investing the same monthly amount. So to start things off, let's say that Emma starts investing January 1 of 2024, right? So she's at 25 years old, and she's hoping to retire by the time she's 65. So we'll give that 40 years of a time horizon. Now, the interest rate's going to be set at 7%. What interest rate means is this is the return on your dollar. So typically within the U.S. stock market, what's called the S&P 500 index, which is the top 500 companies in the United States, and those companies get cycled in and out depending on their performance. But a lot of people use the S&P 500 as a kind of a baseline for the U.S. stock market. Now, that's not set in stone, but that's just kind of a consensus across a lot of financial individuals and what people kind of gauge as a benchmark for their performance against the stock market. More on that in other videos, but for the basis of this, let's just focus on this interest rate. So say you invest $100 in a year and you have an interest rate return, you have a return on your $100 of 7%. At the end of the year, you'd have $107. Now, I understand that doesn't sound like much, but one thing to keep in mind is just how important and impactful compound interest is in the long term. So the object here is early and often. What I mean by that is you want to invest early and you want to invest often. So in this scenario with Emma, we have a 0% initial investment. So we're going to start with $0 in the account, and we're going to deposit $200 monthly at the beginning of each month. And we're just going to do that for the period of 40 years. So we're going to calculate this. And as you can see here, at the future projected amount for Emma is $528,000. Now, I don't know about yourself, but if you told me I could invest $200 a month into a relatively low risk investment fund, ETF, S&P 500 mutual fund, something of those index funds, something like that, that's going to be a lower risk investment. And I don't want to call it a guarantee, but a high likelihood that your investment's going to be worth, over $500,000. I would take that, right? You can probably find $200 in your budget somewhere. I understand a lot of people are strapped for cash. They might just be barely making ends meet, but the purpose of this is to just show you the possibilities. The reason I'm sharing this video is I've had a lot of conversations with close friends, and I've come to discover that a lot of people just don't quite understand the power of compound interest and how impactful it really can be for your future self. So total deposits here would be $96,000 over the course of 40 years. And the total interest earned is $432,000. So down here below in this table, you'll see our initial 0-1 starting balance is $0. Our initial first year, a total deposit, so that's money in, is $2,400. And on that $2,400, we've earned interest of 90, call it $93. So at the end of year one, we've earned $93 of earned money, right? So we didn't do any more work for this cash. This is putting our money to work for us. And you might say to yourself, Scott, $93 on $2,400 is stupid, right? I get that, but $93 is more than what you had before, right? And $93 is money that your money has earned for you without doing anything for that. So $93 is your accrued interest in year one. Let's jump to year 10. In 10 years, you've accrued $10,818. That's pretty good. You've done no extra work. You ideally have set this deposit and purchase stuff on autopilot, meaning auto withdrawal from your bank account, auto purchase on your the platform that you're using to trade stocks and ETFs and whatnot. Whether it be E-Trade, Webull, TD Ameritrade. There's a lot of different platforms out there that you can use. Okay, cool. So you're saying $10,800 is stupid, right? Okay, that's fine. Let's jump to year 20. You've made almost $57,000 in interest. That starts to turn into something. However, let's jump another 10 years, and this is really when you start to see the effects of compound interest. So from year 20 to year 30, you went from 57,000, call it, to 173,000. It's pretty significant. Now, the last 10 years of time is when compound interest really starts to take off, and you go from 173,000 to almost $400,000 in accrued interest. So in a 10-year span from year 30 to year 40, $432,000, your money's more than doubled in a 10-year period. And the longer that you delay needing to have access to this cash, it gets bigger and bigger and bigger. So let's jump back up here and go from 40 years. So our ending value is $528,000. And let's increase it to 45 years. So 45 years. In 5 years' time, you can see the massive jump from 528,000 to 63,000. It's a pretty significant number, pretty significant difference in a 5-year time. All right, so that was for Emma. She started investing at age 25, retirement age of 65. Let's just show the importance of a 10-year difference between her and John. John started to invest at age 35. $245,000. That's a pretty massive difference, right? 528,000 to 245,000. Just because John started investing at age 30 and only has a 30-year time frame versus Emma having a 40-year time frame, right? So in order to have John catch up, let's see what he might need to do on a monthly basis to get to about $528,000. So more than doubling his number monthly from 200 to 400, he's still shy of what Emma has done only because she has 10 years time on him. So at $450 a month, he's just above Emma. So at $425 a month, John can essentially play catch up. Emma contributed $96,000 in total investment. In order for John to catch up, he has to invest $153,000. So time duration is massive in terms of compound. It allows you to have access to more cash in your monthly living the sooner you invest, if that makes sense. So another way to say that is you invest sooner and often. Later on down the road, you're not going to have to invest as much to play catch up. So moral of the story is try to get started as soon as you can. You might be 50 watching this video, and that's okay. 50 is better than 60. Take the time to learn your budget, understand where you can kind of invest some dollars, where you can shave some spending and invest. You have to invest in yourself. Like, nobody's going to take care of you. Oh, the government, the data. You don't want to be in a government facility when you're 70. You don't want to rely on Social Security when you're 70. Take the time now to learn about money. Take the time now to learn about compound interest. It's not that challenging. I promise you, it's not that difficult to get started on a path to give yourself a way better life and peace of mind in the future. Take the time to learn. I'm here to help you if I can. I only make these videos because I want people to have an avenue to understand the significance of investing in themselves moving forward. So I'll leave you with that. If you have any questions, please leave them in the comment section below. And at the end of the day, you have to do what's right for you. Investing in yourself is one of the most important things you can do to protect yourself and your family in the future and take control of your own life from a money standpoint. Money is not evil. It's not the root of all evil. Money is a tool. You can use it for evil, and yes, people do. Money is not the only goal in life. Money is a way in which to get things that you may need or want, but it's just a tool at the end of the day. That's all it is. And like I said before, if there's anything I can do to help you, please leave a comment in the comment section below. I'm happy to share any knowledge I have. And thank you again for stopping by. I do appreciate it. Happy investing, and talk to you soon. Thanks.